Morning and welcome to the Affluence LIC Fund webinar. Thanks for your time today. I'm going to walk you through today our Affluence LIC Fund, and hopefully that should take perhaps half an hour, perhaps a tiny bit more, and we'll see how we go from there. Happy to take questions at the end, so you're more than welcome to type some questions in along the way as we go. First, a disclaimer, obviously, we are talking about our fund. Distributions and capital returns are not guaranteed. Past performance doesn't guarantee future performance, and you should, in fact, speak to your financial advisor if you have one before making an investment decision. So we're here today to talk about the Affluence LIC Fund. It has been around for just about 5 years. It's about to have its 5-year anniversary in May this year. And we think it's gone pretty well. It specifically invests in ASX listed investment companies. We'd like to continue to have the best chance for it to do well. And so we're going to most likely close this fund to new investors on 30 June this year. And so if you are invested now, or if you're invested by then, you will still be able to continue to add to your investment after that, but it's likely beyond that date. No new investors will be allowed to come into the fund. The fund is, of course, invested in LICs, which are impacted by the wider stock market. So when you're thinking about this fund, it is an equity style fund. And if you're not comfortable with the sort of risk that comes with equities, then it may not be for you. And perhaps something like our Affluence Investment Fund might be worth looking at. Very quickly, I'm going to go through the introductory stuff quickly because there is a lot of information out there about LICs. So I'm going to assume that most people have a working understanding of that and a little bit of an understanding of the fund. But if not, there is plenty more information on our website. We have a guide to listed investment companies and on the fund page itself. So when I talk about LICs, the fund itself is unlisted. To come into our fund, we accept applications and withdrawals monthly. The fund invests into listed investment companies. And what you need to know about listed investment companies, or LICS, is two things. Firstly, they are, in essence, just managed funds or investment vehicles that are listed on the stock exchange. So just like any managed fund or just like any ETF, except that you can buy and sell them on the ASX. The second thing you need to know about LICS, which is a big part of the reason our fund exists, is that unlike a managed fund, they don't trade at their value of the assets they own. They don't trade at NTA. They may trade higher or lower, depending on the whims of the market and who's buying and selling. And that for us is a big opportunity potentially. And hence the reason that we have the LIC fund. So the big opportunity is the third group of bullet points on this list, and that's the ability to be able to buy at a discount and sell at a lower discount or a premium. There's also some other reasons we like the LIC space. Firstly, there's a lot of very, very good managers that run LICs, some of which you can only get through their LIC. In other words, they don't necessarily have an unlisted fund or an unlisted fund that's open for investment. And secondly, you can construct quite a diversified portfolio across particularly Australian and global equities, but also other types of assets are more prevalent in LIC land than they used to be as well. Now, we put together a portfolio of 20 to 35 LICs. The entire investment universe is about 110 at the moment. We strip out a few of those. Some of them are very, very small. Some of them, for other reasons, we don't think are investment grade, or perhaps they're not exciting enough. And so our effective universe that we pick from is about 60 to 65 LICs. And we're looking for three things. We're looking for the ability for the LIC manager to deliver very good returns, and or for the assets the LIC owns to be cheaper than they should be. We're looking for discounts greater than average, and we're looking for special situations. And those are the three areas where we get the returns for the fund, and probably in that order. So the biggest part of the return comes from the investment activities of the LICs themselves and the dividends that they pay. We make money from discounts and buying and selling well, and we make a little bit from some of the event-driven or special situations. We do change the portfolio over time quite a lot. It's quite an active strategy, and we vary the amount of underlying market exposure that we have through the cycle. And we do this for all of our funds. So if we feel markets are expensive, we're likely to have, for example, more cash, or we may use put options, or we may own more LICs that have less market exposure. If we're feeling markets are super cheap, we'll be doing the opposite. We'll be fully invested with very, very little cash. This is the performance to date for the fund for the 4 years and 10 odd months that it's been going. You'll see from the top part of this slide, we're looking to do 4 things. We're looking to construct a diversified portfolio. We're looking to beat the ASX200 Index, including dividends, over 3-year periods. We're looking to give a minimum distribution yield of 5%, and we pay distributions in this fund quarterly. And we're looking to make the fund less volatile than the ASX itself. And we have, in fact, delivered on all of those aims so far. So you will see, since inception, 12.9% per annum returns versus 9.3% for the ASX 200. So around 3 to 4% outperformance. And we've done so with less volatility than the ASX 200. In other words, we've tended to fall less when markets have fallen, and we've tended to rise less when markets have risen. But overall, we've achieved a better result. This is distribution profile. I have talked about this before. If you've heard me talk about the fund, we target 5%. We've actually done just over 7. But I say to everyone, assume 5. That's what we're really aiming for, and treat everything above 5% per annum as a bonus. And that's kind of the way we look at it, is that we would tend through the year to pay quarterly distributions at about that 5% per annum rate. And then in June, if we've had a good year, we're likely to pay a slightly larger distribution. And you can see that on the table here. You can see for each June, generally speaking, there's a larger lump. It was a very large June last year. And that depends on the sort of income we've generated in the fund for the year, and more particularly, whether we've generated substantial taxable capital gains. So if you assume 5 and we do better, that's going to be a positive surprise. Now, I thought it was useful just to look at last year's performance in more detail, because it probably gives a good example of how we would expect the fund to behave in different environments. And we obviously had a range of very, very different environments last year. We went from peak to trough, and in some cases, particularly the US, back to peak again. So it's worth digesting that and just seeing how we performed in those different environments. So for the full year last year, the ASX 200 did 1.4%, and the LIC fund did 20.2%, so substantial outperformance. And if we break that down by quarter, the first quarter, minus 23% for the ASX 200, minus 14% for the investment fund. So we did do better, but again, if you couldn't stomach a 15% fall, for example, this is probably not the fund for you. So it's not going to be immune to market falls. We just hope to do better than average. And there were a few factors that helped us do that. Firstly, we were quite well positioned going in because we felt markets were overvalued at the start of last year, and therefore we were holding more cash, more put options, and lower market exposure than we might otherwise have done, and that helped us a lot. And then through Q3, Q2, Q3, and Q4, you'll see the market improved substantially in Q2, as did we, but we didn't quite keep up. So again, in a strongly rising market, we're not necessarily going to keep up, but we're still going to give, hopefully, a pretty good return. We had a very flat Q3 in the ASX, and we did a lot of our best work in that quarter. And that was due to us being able to switch very quickly between different opportunities. And in LICs, when markets get dislocated and recover like that, if you can get through the down part well, we then have a dearth of opportunities to be able to make money, and we can be quite active in that space. So, you know, back in March, April, May, June last year, we were probably at our maximum holding level. We were up around that 35 LICs because there were just so many things that screened as good value. And then as the year's gone on, we've taken profits on a lot of those and gradually reduced down to now we're a more concentrated sort of 20 LIC portfolio. Q4, we actually did keep up in a strongly rising market, and that was most particularly down to November last year, where what we saw there was a big push back from value. So you're probably aware that over the last really 10 years, growthy stocks have substantially outperformed value stocks. Now, that's been quite an unusually poor period for value, but it finally started to show a bit of a recovery in November. We saw a good month, and that was a big factor that helped us keep up through last year. The other thing I should say is, because we bought quite well in March, April, May, we also benefited, and the fund benefited from quite a few of the underlying managers who were able to take advantage and do very, very well last year. And I'll talk about some of those in a little while. So basically, we behaved, albeit in a fairly extreme year, roughly the way we'd expect to behave, in that the fund performed better than average in a falling market, better than average in a flat market, and couldn't quite keep up in a strongly rising market. Now, we talk about discounts and premiums a lot. I'm going to give you a couple of examples of that, but we talk about this term called discount capture. What does that mean? Simply what that means is that if we can buy an LIC cheaper than average, hold it, and then sell it at a lower discount or even a premium, we can add some value over and above the returns you're going to get from the LIC itself. So if you buy an LIC at a 15% discount and you sold it 3 years at only a 5% discount to the value of its assets, that's an extra 10% you've made over and above the returns the LIC itself has generated through its investment activities. So it's really a second bite of the cherry, and that's one of the reasons we think this strategy is interesting, because you've got the ability not only to make money from the LICs themselves, but from those changing discounts and premiums. At an overall level, again, this is a chart we show a lot, but I think it's important to understand how the environment looks. This is the average discount across the board for our portfolio. It's not quite apples for apples because our portfolio does change, but the trend you can see is that those discounts were roughly 6 to 8% for the first 3 years the fund existed. And then they gradually got bigger and bigger and bigger. In March last year, we were buying LICs on average at 25% discounts, and in fact, some much, much higher than that. Since then, we've been seeing this gradual recovery, flattening off in the last few months. And at the moment, the portfolio of the Affluence LIC Fund is around a 15 to 17% discount to the value of those underlying assets. We would think that over time, normal is somewhere closer to that 6 to 8% range. So that does provide some scope for some additional returns over perhaps the next 2 or 3 years. We don't think we'll get there necessarily in the next 12 months, but over time, we can continue, we think, to add value through that. Now, here's just a couple of examples of quite extreme pricing changes and where the returns came from. This is WAM Alternatives. So it used to be the old Blue Sky Access Alternatives Fund. And we looked at the period between the end of March of last year, where obviously prices were pretty low, and February this year. And if we look at WAM Alternative, what we see is that the NTA, or the value of the fund's assets of WAM Alternative, grew just 3% during that period. So they didn't particularly fall because it mostly holds unlisted assets, but it didn't particularly go up either. So 3% per annum was the return. However, you could have, and we did, buy some of WAM Alternative at 65 cents last March, and you could have sold them for 99 cents. And so that discount went from 40% into just under 10%. And the combination of those two things led to a 56% return for WAM Alternatives over that last 11-month period. But the vast, vast majority of that, over 50%, came from that discount closing up. And as you'd appreciate, when discounts get that large, the inverse is true in that the upside is bigger. So, for example, a 50% discount needs 100% gain to get you back to NTA. So when you see those discounts blowing out, they're real opportunities potentially to add a lot of value. Now, we spent a lot of time on this. We liked it because we were actually comfortable with the underlying portfolio and that the damage was done and it wasn't going to get any worse, which proved to be the case. It was suffering at the time from being associated with the downfall of the Blue Sky business, and we knew a number of activist investors were coming onto the register. We thought that either a wind up or a change of manager was very likely, and that's in fact what occurred, a change of manager to the Wilson Asset Management Group. So a good example of where the underlying NTA didn't move much, but we still made very, very good money. The second example is L1's long short fund. L1 has a long history as a fund manager, but a much shorter history as an LIC manager. And they had a really tough time post the IPO of their long short fund in, I think it was about 2017, 18. So by March last year, they had a pretty horrible COVID. Their portfolio, because it was geared towards economic recovery, actually performed quite poorly. And the NTA was actually down quite a bit, but the share price was down even more. So we picked that up at just under a 30% discount, around 86 cents back in March last year. Fast forward to February, their portfolio itself has recovered incredibly well. They had a lot of stocks that were very much exposed to the recovery trade, and that's proven to be the case. So they've delivered returns of 113% at the NTA level. The NTA, the share price has improved even more because that discount has closed from 29 to 17%. And in fact, the share price return is up to 147%. So you can see there, again, a very, very good underlying return enhanced by the ability for that NTA discount to reduce. Now, they are extreme examples, but the point is that if you can just even make 1 or 2% a year from that discount closing, you can actually do very, very well. That does make a lot of difference over the long term. Turning now to the portfolio, you can see some high-level statistics here. These are the 4 graphs that we put in every monthly report for the fund. So we look at the discount bands, we look at the size of the LICs in the portfolio, we look at the geographic exposure, and the sort of strategy that the LICs are running. So at the moment, almost half the portfolio is at a 15% plus discount, and another quarter between 5 and 15% discount, and we're carrying about 10 or 11% cash. You can see here on the market cap side, we're seeing very much a good spread. So we've got just one LIC that's $1 billion or more, that's 6.5% of the fund. We've got a few in the 500 million to $1 billion range, and then quite a few smaller ones as well, right down to 0 to 50 million. Now, we can't have a lot of LICs in that space, but we are able quite comfortably to buy in this $50 to $250 million range. So that works quite well for us. And that's where a lot of the opportunities and the mispricings are, really below 500 million and above 50 million, where you get that combination of both liquidity and also pricing changes. Geographically, we've got quite a high weighting to global LICs at the moment. There's a lot of opportunities, and in general, the discounts are slightly greater for global, which actually is the case a lot of the time. However, if you look at our hedging profile, we have hedged out some of that global exposure. So our net exposure is probably a bit more weighted to Australia than global. And you can see here a whole mix of strategies, quite a bit of long only equities exposure. So LICS, which just invest in ASX or global equities and hold those. And then we've got various other strategies, which in summary, take some of the rough edges off, some market neutrals, which effectively should have very little market exposure, some diversified, and some other strategies as well. So it is quite a good mix. Even though there are only 20 in there, it's quite a good mix of diversified names, managers, sizes, and underlying strategies. I'm going to talk you through some of the bigger names in our portfolio. This slide here is taken directly from our website. So if you're interested at any time, if you're registered, you can log in and you can see this. We update it generally monthly after we complete our monthly report, and you'll see the top 8 to 10 LICs as well as how much cash we're carrying here. So I'm going to run through some of these in a bit more detail just to give you a bit of a flavour. Firstly, this is our largest holding, Platinum Capital, and it's a good example of why we say we really like a good good long-term track record and a poor short-term track record. So each of the LICs I'll talk about, we have a similar graph to show you. The lines on the graph are whether that's trading at a discount or a premium. So Platinum's a good example to talk about because we can see both of the curves. So back here, it was trading at a discount in 2011-12. It traded pretty much at a premium all the way through this period, and then it's gone back to a discount. And interesting enough, those periods align with underlying performance. So the share price here is on the left-hand side, and these two wiggly lines represent the NTA, which is the yellow number, so the underlying assets of the Platinum vehicle, and the share price. So you can see when the grey line is above, that's when it's at a premium. When the grey line is below, that's when it's trading at a discount. And you can see that after a poor period of NTA performance, it's no accident that the share price goes from a premium to a discount. So potentially we're buying this at a stage at which the discount is relatively attractive for this particular LIC. We've got a manager who we don't think has forgotten how to invest. They're in an area being long with a little bit of short and very much value focused, which we think is going to have some sort of renaissance. And importantly, they have very little US exposure. In fact, they have been net short at some points in time. And again, we feel like we're trying to avoid the US at the moment. We feel the valuation story there is just out of control. So it's attractive for 3 or 4 different reasons, and that is the reason it's currently the largest holding in our portfolio. Now, we only started buying that back in September this year. It's been a relatively recent addition because we saw the combination of those 3 or 4 attributes come together for us, and we felt like that was a good time to start building a position. L1 I spoke about previously. It did have an absolutely stellar return last year. It was the best performing LIC in our portfolio. It remains our second largest holding for a couple of reasons. Firstly, we still do believe there's quite a lot of legs in the portfolio. Obviously, the post-COVID reflation trade is happening and a lot of the stocks have done well, but we think the portfolio is still relatively cheap. And also, we're still seeing a reasonable discount. So the discount is still around that 15, 16% mark, which means we think over time, if they continue to perform, that discount can actually close right up. So we're very happy, albeit it might be a little bit of a bumpy ride if we see a market correction. We're still very happy to continue to have a decent holding in L1, although we have obviously, given the performance, trimmed it a little bit along the way. VGI Partners is a little bit earlier in the story. So VGI have 2 LICs, VG1 and VG8. VG1, this one focuses on global equities. VG8 focuses specifically on Asian equities. Interestingly, the VGI, again, an exceptionally good long-term track record. They performed exceptionally well during the first part of the COVID correction, as they have done generally in most corrections. But then they performed very poorly in the recovery. And so people have lost patience a little bit, I think. And so that combination, in combination with a traditional kind of post-IPO hangover, which can last 2 or 3 years, has meant that we saw the share price trend down a little bit and the NTA blow out quite a lot. So during this period here, we were buying both VG1 and VG8 quite heavily. They're currently about 8 to 9% of the portfolio combined. We believe over time we're going to get pretty decent returns from the VGI team, and we also believe that, again, that discount can close up quite a lot over perhaps a 2, 3 or 4 year period. Very good managers, very well aligned, very shareholder friendly structure, and those are all things we think are important to look at when you're looking at an LIC. This is more of a niche play. This is NGE Capital, run by David Lamb. It's a very small LIC at just around $20 million. We like it because of the ability of David to make pretty decent investments, but it's a very concentrated portfolio. And at the moment, there's about 30 to 40% cash in the vehicle, and the balance is in a very small number of high conviction resources plays. We like that aspect of it right now. We like the exposure to resources and the ability of David Lamb and his team to potentially make pretty good money for us. Interestingly enough, even though the discount is around that 20 to 25% mark, that doesn't make it particularly attractive more than usual for us. And the reason for that is that you can see from the history there that the discount has at large amounts of times been around that 20 to 25% mark. So it's not exceptionally cheap by the standards of this particular LIC. If it was 30 or 35, we would be very, very excited about it. It's also less liquid, so that does in a way restrict us a little bit on position size. But we feel, again, over a 2 to 3 or 4 year period, particularly if resources continue to do well, and we think they might, that this LIC is going to do very, very well. WAM, I talked about earlier, this is the blue sky story, and this really has almost played out for us now. So we were buying this particular LIC about 3 years ago during 2008 when Blue Sky, the manager, hit its troubles. We knew the portfolio pretty well. We did a lot of work to understand that fairly early on. So the underlying portfolio includes some real estate, some private equity, and most notably, or some cash, and most notably some agriculture and water right assets. So it's quite differentiated in terms of the LIC space. There are only 2 or 3 others perhaps that are going to give you a similar exposure. It was pretty messy back here going through the blue sky stage. A lot of activist investors and others like us got involved, and ultimately we saw a change of manager to WAM Capital. And you can see that the discount has closed up quite a lot and the share price has risen up quite a lot, even though the underlying portfolio, for all intents and purposes, has done very little over the last 3 or 4 years. But we've been able to make pretty decent returns out of just playing that discount recovery story. It's ebbed and flowed a lot, and you can see we have actually changed our holding during that period up and down as that discount has ebbed and flowed, but it has been one of our better investments. We hope that it will continue back towards NTA, and at some point it will be, most likely, if that happens, a much smaller position for us. This is one we think's got a decent yield potential, but also some other things we like. So we almost never would invest in LIC purely on the basis of its yield. We think that's probably one of the worst ways you can go about it. It's you know, the LIC sector can be full of value traps. You've got to be careful. Sandon has other features we like. It is quite an activist strategy, and they've delivered general 11 to 12% returns through the cycle over a reasonably long period now, which we think is pretty good. It does have a reasonably high yield at the moment. It's sort of in the 5 to 6% range. We increased our holding quite a lot. The portfolio got hurt quite badly during the COVID and then has recovered quite well. And we increased our holding substantially, having held a bit pre-COVID, and have done okay out of that. You'll see the discount, again, expanded and is contracting. And we think that hopefully will continue to contract, although possibly more slowly from here. But we're very happy to hold it at that level of discount, given the likely returns we think that Sandon can generate and that the strategy is quite differentiated from others out there. Australian Leaders Fund is another in our portfolio where it's almost finished going through our portfolio life cycle. So this was a market neutral style strategy designed to, in theory, make money irrespective of markets. And it had done very, very well going back a number of years. Unfortunately, the last few years have not been kind, and you'll see from the NTA line that it has essentially lost money, net of dividends, and probably broken even, including dividends, over the last 5 or 6 years. That led to, predictably, the discount increasing and shareholder impatience. And mid to late last year, they did finally do something about that, and they announced that they were going to delist Australian Leaders Fund and turn it into an unlisted fund. And that transaction is almost complete. It'll complete early in April, and at that point, all investors will have the ability to redeem their holding at net asset value. So you're going to get out at net asset value. So we've made money on that. We've made reasonable money on that, but all of that money has really come from that discount going from perhaps 15 to 20% over the last couple of years down to 0. We've net lost money on the underlying NTA of Watermark. This is what we call our Desert Island stock, FGG and FGX, and it's a very diverse underlying portfolio that Jeff Wilson and his team put together. There's also a global version called FGG, and there's a couple of other similar ones out there. In essence, what these funds do is they have a very diverse investment base. In the case of FGX, it's all Australian equity focused through a range of managers doing different things. All those managers work for free. And so instead of paying managers fees and other costs, the LIC itself, FGX, donates 1% a year of charity. So as an investor in FGX, you're seeing, instead of paying a management fee, you're seeing that money go to charity, which is good. It's also been a reasonably good performer, and it generally has been in our portfolio for the entire time we've been managing the fund, although we do flex the position size up and down a little bit depending on the other opportunities that are out there. This is a recent buy and perhaps shows what can happen when yields get out of control, and it also shows the benefit of being patient. So Djerriwarrh is run by the same team that runs AFIC, which is the largest LIC listed on the market. So you're getting a very good team with a good pedigree. Over a long period of time, the returns have been quite similar to the ASX200. What happened with Djerriwarrh is they have a little tweak to their strategy where they specifically sell call options to generate additional income, but in doing so, they perhaps give away a little bit of the upside if markets rise quite strongly. Net over time, that tends to give them a similar or slightly lower return than the ASX, but a bigger income component. And they use that income component to pay very high distributions, which drove the premium and the share price much, much higher. It got up at one point to about 40% premium. And then unfortunately, through a series of events, they had to reduce those dividends down again. We saw the premium disappear completely and in fact turn into a discount. We've bought Djerriwarrh just in the last month or so. They were running a share purchase plan, which tends to temporarily slow down the share price a little bit because obviously shareholders are buying shares through the SPP rather than necessarily buying them on market. So we use that opportunity to buy a 3 to 4% stake into Djerriwarrh. We think that we've seen the bottom in dividends, and we think that generally they're going to start increasing again over a 2 to 3 year period. We think that can lead to Djerriwarrh trading at a premium again, as it has in the past. And just by way of contrast, I mentioned that AFIC is pretty much the same team. AFIC right now is going to, you're going to be able to buy that at maybe an 8 to 9% premium to the value of its assets, whereas Djerriwarrh is trading right now, I think, at a 6 to 7% discount. So we're seeing almost a 15% gap between those two LICs. Essentially, it's the same team running very similar strategies. Again, that's the reason we think Djerriwarrh is pretty good value at this level. There's a range of other holdings in the portfolio, which I'm happy to talk about. We've only got a limited amount of time, so we won't get to all of them today, but there are certainly a few other opportunities in there that we are excited about. The other point to make, just graphically, which I've mentioned, is that larger discounts can create larger opportunities. So this shows you if you buy at a 5%, if you buy an LIC at a 5% discount and it goes back to its NTA over time, that's 5.3% upside. If you buy at a 10% discount and it goes back to NTA, that's 11%. The point of this is that as you get bigger, the upside, the gap is bigger. So at 20% discount, if you're buying an NTA of $1 for 80 cents and it goes back to $1, you're actually getting a 25% return on your 80 cents. Okay, and the important thing about that as well is not only are you magnifying the capital you've put in, but you're also getting a magnified return on the underlying manager as well. So if that LIC that you bought at $1 gives a 10% return for the year, 10 cents, that's 10 cents on $1, but it's actually 12.5 cents on the 80-cent price that you would have paid for it. So you're getting magnification not only in the capital that you spent, but also the returns on that capital as well. And that's perhaps an often overlooked little benefit of buying at a discount, particularly when you can buy at 10, 15, 20% discounts. The gap gets a little bit bigger. That's really the core of what I wanted to go through today. Very happy to take questions if we have any. But just in summary, what you're getting with our LIC fund, you're getting a very specialised strategy with an additional way to hopefully make some extra money around that discount capture strategy, and obviously access to the great pool of managers in LICs. The fund is small, it's going to remain small, and we want to do that because that's the way we can deliver the best returns. We'll likely close it in June to new investors. The performance so far obviously has been pretty good, and particularly so coming out of the correction in 2020 when markets were a bit more dislocated and opportunities were varied. We've managed to deliver also pretty well on our distribution aims. And the thing I haven't mentioned, which is again the case for all of our funds, is both myself and Greg, who manage this portfolio, are aligned. We co-invest in the LIC fund and in all of our funds. We charge no fixed management fee. We get paid through only a performance fee, 12.5% of positive returns. And we do, and this is important when you have a smaller fund, we do cap the costs of running the fund at 0.25% per annum. So if the costs are higher than that, the manager Affluence will pay those costs directly. So it's important, very much important, and this is an important thing when we look at LICs as well, to see that alignment between the investment staff particularly and the LIC itself. It's the core information about the fund. As I've mentioned previously, monthly applications and redemptions, the minimum initial amount is $20,000. Quarterly distributions, we suggest if you're looking at this, you think about it as with all equity products over a minimum 5-year return. The fees are there, and we have a very small buy-sell spread, 0.1 in and out, which just is a one-off cost coming in and out of the fund, and that essentially just covers the brokerage cost of us putting your money to work. There's information there if you'd like to learn more about the fund. The best way to do so, you can give us a call at any time, send us an email. You can look at the website. We have a dedicated page for the fund. If you'd like to invest, you can just follow the link on our website to apply online or download the documentation. If you want to keep in touch with what we're doing, if you're new to Affluence, I'd encourage you to go to our website and subscribe to our monthly newsletter. It includes our fund reports and anything else we found interesting about markets. If I can now, that's really the end of the formal session, but I do have time, perhaps 10 or 15 minutes to take some questions. If we do have any questions, feel free just to go into your Zoom and type in a question there, and we'll get to them if we can. First question I've got here is from Anonymous, and they're asking if we're disappointed by the AEG conversion not going ahead. So that they were going to delist and turn into an unlisted fund, as we saw happen with Australian Leaders Fund. This went on for quite a few months, and then more recently they announced that that transaction wasn't going ahead. We're not privy to the full story. We didn't own it over the last few months, and the reason was that it had re-rated quite strongly ahead of that announcement. So there was clearly an expectation in the market that that transaction was going to happen. And interesting, when it didn't, even though the board hasn't really announced any other strategy to continue to keep the NTA low, the NTA discount hasn't really increased. So it's quite a, even though it's market neutral, it can be quite a volatile strategy. It's not one that is in our portfolio right now, but it could well be in our portfolio at some time in the future, and it has been in the past. Got a question here on yields. I had a question earlier on yields. Where do we think yields are going? And that's one we get often. As I said earlier, we don't particularly focus on the yield as a primary kind of reason to invest when we look at an LIC, but obviously we're chasing a total return. Obviously, if we can get more yield, that's fantastic. We can get higher dividend, that's great, but we don't need it. it's fair to say that if we were going to buy based on yield, we would look at the over a 2 to 3 year time frame. So there are quite a few LICs out there where the yields are not particularly great now. They might be 2 or 3 or 4%, but we think they can grow. And so where we think they can grow, that's the thing that's going to perhaps make them more attractive in time, and potentially make them even trade at a premium. So one example I can give of that is Plato, which we don't hold. It listed, traded at a bit of a discount for a while. Then they pay monthly distributions. As those distributions ramped up, it went to the point where it's trading at a premium. Now it's trading at a premium on a sort of a 5 to 6% yield. We don't think now's the time to buy that. We think the time to buy it might have been back when it was trading at a discount in the early days. So we've got a few like that where we would probably more likely avoid them because they're already fully priced based on that yield. I've got a question on MGF, which I think is either MF, I think it might be, and the option drag. So just to clarify that, a lot of LICs used to issue options as a way to grow the LIC over time. And so if you were a shareholder today, you would get essentially a free option that you could exercise perhaps in 2 or 3 years at a higher price. And if the LIC expired worthless. So they're good and bad, and they have worked well in the past, but they don't always work well. So it's something that we don't do a lot of these days. We don't own a lot of options. It's very tricky to know sometimes whether to own the shares or the options or both. There are a wide range. So generally speaking, we don't own too many LICs right now that have options on issue. That they can be a drag. And so if you want to be sure you're getting the right answer, sometimes you have to buy a little bit of both. There's a question about the fact that I did mention 2 very, very positive discount captures, and can I talk about one where it didn't work well? Very good question. I'll tell you about probably one of the worst performing LICs of the last 18 months, and it's one called Tribeca's Global Natural Resources Fund. It's one of the few where we participated in the IPO, and it went very poorly. On the surface, it was an attractive strategy, investing in natural resources as well as having the ability to make loan investments in natural resources, which in theory should be a good hedge against market falls. In reality, the opposite occurred. They had a very large loan write-off, which hurt the NTA, and then the market for resources didn't go great, and then the NTA discount blew out. And so it went and literally from about a $2.50 initial share price down to somewhere around $1. So we took a lot of that pain. We still believed in the strategy, and we still do believe in the strategy. We actually bought more post March, April last year and topped up. But we did do very poorly on the way down. We topped up. Right now, the NTA has recovered substantially. It's not all the way back to $2.50, but I think it's around $2.30, $2.40. The share price is just under $2, so it's recovered quite a lot. And we have actually made money on TGF by, we were convicted that it was still a good strategy. We were convicted that the assets are still good assets to own. Question on fees and how do our management and performance fees compare to traditional fees? I would say the beauty of our fee structure is it very much depends on the returns you get as an investor. So if we deliver a return of 0 in the fund, we get 0, but you get 0. So everybody's aligned. So we're cheaper than average, but no one's really happy. If we have a year like last year where we delivered close to 30%, then our fees by traditional standards are exceptionally high. We're going to make 3.5% for that, but you should be very happy about that because you made 30. And if we have a for any reason a negative period, the rule is that we have to wait until the fund makes that negative period up before we can charge a fee again in the future. So interestingly, the reason we did this the way we did is that the break-even point is about an 8 to 9% return. So at an 8 to 9% return for the fund, the management fee we will get, or the performance fee we will get, is around that 1% per annum, and that's about a standard fee. So if we deliver average, we get average, and better or worse, we win or lose along with all of our investors. So that's a good question, and it's probably an important one to understand. The interesting thing is that amongst boutique managers that we deal with, and we deal with a lot of unlisted funds as well, we're seeing a lot more managers who are taking a similar stand, who are saying, look, we're happy to earn the bulk, if not all, of our fees just for performance, and we're happy to earn virtually nothing or nothing if we don't do well. Question about MGF selling at a discount. I'm not sure what that's would you buy now in anticipation of the discount closing? I think that might be referring to one of the Magellan funds. I'm not totally sure of that one. So I can't really comment on that one. So I'm not sure. Another question about closing the fund. Could I explain that in a bit more detail? Yes. So closing the fund is probably the wrong word. We're closing it to new investors. So in essence, it's called in the industry a soft close. And what it means is that if we say 30 June's the date, if you've invested with us before 30 June, then you are able to continue to add more to your investment, or to withdraw, or to do whatever you like. So there's no change for you. If you're in, you're in, and you can continue to invest. But if you are a new investor coming to us after that date, you wouldn't be able to put any money into the fund. And the reason we do that is it preserves the capacity that we've got left for those who've supported us up to this point. So it allows existing investors to continue to add to the fund up to the amount that we have capacity. At some point in the future, we will say, okay, the fund is closed to all new investors. And that'll be at the point where we're not sure when that will happen, but if the fund does keep growing, there will be a point at which we feel that it's starting to constrain our ability to make money. And it is probably the single biggest misunderstanding about managing money, is that the optimum amount of money to manage is probably less, not more. It depends on what you're doing and what you're investing in, but we're certainly aware of plenty of funds which can take 20, 30, 40 million, and that's all they want to do. There are others which can literally take billions. If you were investing in mainstream fixed interest or global large cap equities, capacity in theory is very, very large. But generally for all funds and all strategies, the rule is essentially the more money you have, the harder it is to outperform. So we're trying to find a good balance here between keeping the fund at the right size to maximize the potential, and also looking after, as I said, those investors and advisors who have been good to us and who've supported us on the way through. I think that's all I've got questions for now. I'll just wait for a minute or so more. If you do have any other questions, feel free to type one in, and I'll be happy to answer it. Otherwise, you're also more than welcome, as I said earlier, to send us an email or to give us a call anytime during business hours, and more than happy to have a chat to you directly. It looks like it's about it. Probably just before we end, there's probably just one more that I kind of forgot that I wanted to highlight, and Greg's just reminded me, which is back on slide 26 here, these three LICs I talked about at 40% discounts. That's three funds called Cordish, Dixon 1, 2, and 3. And what's happened there is the fund manager holding company has gone through a rough patch, similar but not as extreme as Blue Sky, and they're kind of losing a few of their clients, I guess. There's been sustained selling of those LICs in small batches. The LICs themselves invest in US private equity through a family office. So the US-based investment team are making those investment decisions. They've actually performed pretty well over the last few years, and we think they can continue to perform pretty well. And we've been buying those generally over the last 18 months or so at between 30 and 40, sometimes as high as 45% discounts. We've built a reasonable position between those three LICs, even though individually they're not in our top 10. Between the three of them, they're probably close to 10 or 11% of the fund. And we think that if we're prepared to be patient, similar to what happened perhaps with WAM alternatives, that there is potentially upside through that discount closing, and also through potentially performance of those funds. So we look at those over the next 2 to 3 years as possibly the most exciting collective investments in our portfolio. So that's just probably an example of where we see some extreme value. Interestingly, we've recently hedged out, given the only thing we don't like about it is that it is US exposed, albeit through unlisted private equity investments. Given that, we have actually hedged some of the US market risk out of those more recently. So we can potentially still benefit if the NTA discount does close over time without necessarily taking all of the pain if we do see a US market correction. Okay, so that's almost it. I did just have, well, I've got a couple more questions come through. So just quickly, if you're happy to hang around, I'll keep answering them. Question as to whether it's possible to take some cash out without closing out of the fund, closing your investment. Yes, absolutely. So once you're in the fund, you can withdraw again monthly. So come in or out at end of each month. You can withdraw any amount you like, provided you maintain at least a $10,000 investment in the fund. So in theory, you could withdraw all but 10,000 and continue to then add to that again over time. Finally, a question on URF. URF is a US-based residential. I guess it's an LIC. It's probably a cross between an LIC and a REIT. It's not one we own. We have in the past owned, unfortunately, it's gotten into a bit of trouble because it geared up quite heavily and it had a number of listed notes and preference shares on issue, as well as bank debt as well, which has caused a lot of problems. And so they're progressively being repaid. We have owned some of those unlisted notes at times, but we don't currently and don't have plans at this stage to own it. It's whilst we can see a case where it's trading at a big discount, we can see a case where there's substantial upside in the current share price. It's got still very high balance sheet gearing, and for us, that's probably too big a risk for us to put it in the portfolio at this stage. So whilst a holder of URF could make very good money over 2 or 3 years, it comes with the potential risk that you could actually get wiped out. So for that reason, it doesn't kind of pass the investment grade hurdle for us at this stage. Okay, I think that is all we've got for now. Thank you for your questions. Thank you very much for being here, participating, and dialing in. We hope you found that interesting and informative. And as I said, if you would like to talk to us at any stage, you're more than welcome to do so. Look forward to catching up. We'll probably do this again in another 3 or 4 months, not directly the LIC fund, but perhaps pick one of our other funds and talk about that in a little more detail. So keep an eye out for that invite. But in the meantime, thanks very much for your time today, and we'll catch you again soon. Thanks.